You see what's happening in London. We see that. We've talked to David Jensen, talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. You see it right here, 103 million ounces of physical that is standing behind 4 million ounces or 400 million ounces of potential delivery. You see the exchanges being bled dry in Shanghai. You're seeing games being played on the ETFs. You're seeing margin hikes. And all along, the big money doesn't give a flying you-know-what. They just keep standing for delivery. If I had to guess, by March, you'll see silver back at all-time highs.
What we are witnessing right now across the silver market is not volatility. It is stress. It is exposure. And according to Andy Schectman, it is the clearest sign yet that the paper silver system is running out of room. 2 billion ounces of open interest in London backed by barely a fraction of that in physical metal. Over 400 million ounces potentially standing for delivery against just over 100 million ounces registered on COMEX. Meanwhile, Shanghai inventories are being drained. ETFs are absorbing massive inflows immediately after engineered price slams, and the biggest players in the world are no longer trading silver. They are demanding it. The January 30th collapse that sent silver crashing from above $120 to the mid-60s wasn't a market accident. It was a coordinated event, a margin-driven flush, a deliberate strike designed to force leverage out of the system. But here's the problem. The big money didn't panic. They stood for delivery. They used the chaos to accumulate more metal. And now, as March approaches, Andy believes we are heading toward a moment where the exchanges may be forced to reveal whether they actually have the silver backing the mountain of paper contracts. He doesn't just see silver leaving the low 80s range. He sees it ripping past prior all-time highs as the delivery mechanism itself begins to strain. This isn't about price swings anymore. It's about structure. It's about inventory. It's about who holds the real metal when the music stops. And if Andy is right, what unfolds in March could permanently change how silver is priced and who controls it. In today's video, Andy breaks down exactly what caused the January 30th slam, how the CME's historic margin hikes played a central role, why JP Morgan and the largest banks were positioned to benefit, and what he believes they've been desperately trying to front-run, the March delivery cycle. He walks through the mechanics, from margin escalation to ETF share creation, and explains why this wasn't the end of the bull market, but the transition to its next violent phase. If you find value in this kind of analysis, please consider liking the video, subscribing, sharing it with someone who needs to see it, and leaving your thoughts below. Thank you sincerely for the support. Now let's get into what Andy revealed.
I think what people need to understand is, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. Becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. This is also true of speculators. And, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin. And that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage. And they force the weak hands out. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw. And futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market. That's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And so these are the big money, the banks. Could it have been a one last attempt to bail out some of these U.S. banks who still had? Now, we've been talking about the Commitment of Traders report that said the U.S. banks are net long. We've talked about the report that came out of the Economic Times that said the banks are net long. But being net long doesn't mean you're long only. That means you have more long than you do short. Now, could this massive price rise and all of this attention that we've been seeing on silver precipitate some concerns by some very big players in a coordinated fashion? They raise margins and smack the crap out of it? Yes. But what they really did was they chased leverage out of gold and silver. And when you do that, you don't make those that are holding said metal weaker. In my opinion, you're putting it into stronger hands. And so, that's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you a kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic and, they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price. What I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF. This tells you that someone with a real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem. But when you line up the delivery pressure that we're seeing, the tightness in the registered inventories, which I want to talk about in a moment, all of this stuff, including what's going on in the ETFs, this is not normal flow. That's inventory reshuffling under what I think is major stress. Richard Russell used to say something like this to me. He used to say that markets don't reveal themselves during the violence. They only reveal themselves after, where price is the weapon, freaks everyone out, but the inventory is the confession. The confession is we really don't have it, but we need to freak everyone out by flushing them out with price and margin increases. But nothing has changed. In fact, now you get into this Project Vault that's come up where, You got the U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price.
What stands out to me isn't just Andy's explanation of margin mechanics. It's what those mechanics expose when you zoom out. COMEX registered inventories are dramatically lower than they were just a few years ago. The LBMA's available metal has been steadily declining. We've now had 6 consecutive years of global silver deficits. Governments are openly labeling silver a critical mineral. The U.S. is discussing strategic reserves under Project Vault. Demand is rising, supply is constrained, and sovereign policy is beginning to treat silver not as a speculative commodity, but as a strategic input essential to national security and industrial resilience. When governments begin stockpiling, that is not a bearish signal. That is a structural shift. And here's where the deeper implication emerges. Margin hikes may shake out leveraged traders, but they do not create supply. They do not replenish vaults. They do not reverse deficits. If anything, they accelerate the migration of metal from weak speculative hands into long-term institutional vaults. The January flush didn't fix anything. It transferred ownership. It cleaned up balance sheets for those who were dangerously short. It gave large balance sheets the opportunity to consolidate physical control at discounted prices. And now, as we move toward March, the real test isn't price, it's delivery capacity.
The March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest. Now, I suppose that kind of sounds abstract until I tell you that each contract is 5,000 ounces of silver. So that's over 400 million ounces of paper silver that is tied to the March contract. The first day that they can stand for delivery is the 27th of this month, so 2.5 weeks away. But if you compare that to what is actually sitting in the COMEX, the registered category as of yesterday is 103.5 million ounces registered, meaning ready for delivery metal is 1 out of every 4. Is that right? 1 out of every 4 ounces, 402 million ounces could stand for delivery, standing against 103.5 million ounces. Now, typically, most of these contracts will roll forward or cash settle, but if even 10% of the March open interest stands for delivery, that's 40 million ounces. If 20% stands, that's 80 million ounces. Suddenly, you're looking at a massive chunk of the registered category, and the market has to react. So the bullish bet isn't that COMEX defaults. I think it's simpler. I think that it's the price of immediacy rises, backwardation, the spreads tighten, and the market has to pay up or pull metal out of the eligible category, which is the other side of COMEX, which right now has 294 million ounces. So we have a Brinks account in New York City, JFK, one of our 8 Brinks facilities. That's COMEX. It's the only one of our 8 Brinks facilities that is a COMEX facility. And we have plenty of people with 1,000-ounce bars in those accounts. Those are eligible. They're not for sale. They could be because they are COMEX eligible. They're in the ecosystem. But no one's going to sell on my side. And all the people that are holding them ineligible, that's not for sale. So even if all of that metal went in, you're talking right now 294 and 103. You're about 99% of open interest right now. And it's all gone. But most of that eligible stuff isn't for sale. The point I'm getting at is that you see what's happening in London. We see that. We've talked to David Jensen, talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. You see it right here, 103 million ounces of physical that is standing behind 4 million ounces or 400 million ounces of potential delivery. You see the exchanges being bled dry in Shanghai. You're seeing games being played on the ETFs. You're seeing margin hikes. And all along, the big money doesn't give a flying you-know-what. They just keep standing for delivery. It's the traders who think that they can play in this sandbox with these people who our money doesn't mean anything to them. And you may be very well heeled. You know, our company is very well heeled with the ability to have a massive inventory and the margin requirements needed for it. But if it kept going up, how much can we post? At what point does it just destroy the ability to maintain an inventory? So what they're doing is they're squeezing out the players who think that they're big enough to play in this game. And really what is happening is you are seeing a strategic repricing that is forcing out the speculators and putting it into the hands of the big money who is standing for delivery. What more do you need to see but that? It's painful, it's scary. Fear is a very, very strong emotion, probably the strongest. And when you see this fall, you get emotional. This is why there's Elliott wave theory and Kondratiev wave theory, the mass emotions of the herd. Separate yourself from your emotions and look at the reality. Nothing's changed. In fact, every day it's getting more and more and more obvious that this is where you need to be. Now, what just happened was contrived. It's BS, should have never happened. Where were the stops on the
circuit breakers on the market? Yeah.
The circuit breakers. So they have reasons why it didn't, and they're using the millisecond thing, a bunch of nonsense, right? They stop it when they want. This was contrived. It was done to, I think, probably either at the same time flush out all the speculators and bail out some of the short positions by the big money. You can't keep doing that. When you see this huge arbitrage going on in China, you can't do it. All of that metal will arbitrage away from the COMEX, from the LBMA. If I had to guess, now I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs. If I had to guess. Now, what do I know? But based upon what I see, the 30+% swing back today, boom, no, why aren't people freaking out when it goes back up 30%? Yeah, we'll get back up there, and I think it'll be buyer before March if I had to guess. And all that happened is that the metal went from weak speculative hands who were holding lots of leverage to the big money that says, thank you so much for that discount. By the way, I won't be standing for any margin. I'm just going to pay cash for it. And if you look, who covered almost 700 contracts at 5,000 ounces apiece at the very, very bottom? Oh, that's right. It was JP Morgan. How foolish of me to think otherwise. Do you get it? The big money is still in control, but they are showing you where this is going. Not ending the bull market, just kind of showing the big traders who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there, and I think that's what we're seeing right now.
The March contract is where theory meets reality. Over 400 million ounces of paper tied to a single delivery month, standing against roughly 103 million ounces in the registered category. Yes, most contracts typically roll forward. Yes, many cash settle. But even a modest percentage standing for delivery begins to pressure the system. 10%? That's 40 million ounces. 20%? That's 80 million ounces. Suddenly, the margin of comfort disappears. Suddenly, the spreads tighten. Suddenly, backwardation appears. And the price of immediacy, the premium for real metal now, starts to rise. What makes this moment different is that the leverage is being drained while physical demand persists. Big money is not playing games with thin margin accounts. They are paying cash. They are redeeming ETF shares. They are arbitraging global price discrepancies between Shanghai, London, and New York. When JP Morgan covers nearly 700 contracts at the very bottom of a forced liquidation event, that's not random. That's strategic positioning. That's someone using engineered volatility to strengthen their hand. And this is where the emotional trap sets in for retail participants. A 30% collapse creates fear. Headlines scream crash. But a 30% rebound the very next session barely registers. Why? Because panic imprints harder than recovery. The system understands that. Margin hikes, volatility spikes, sudden smashes. These are psychological weapons as much as financial tools. But inventory levels don't lie. Deficits don't lie. Strategic reserves don't lie. If silver were abundant, governments wouldn't be stockpiling it. Exchanges wouldn't be tightening rules. And institutions wouldn't be racing to secure physical supply. Andy may have hesitated before saying it, but I won't. If the delivery pressure continues and even a fraction of March open interest stands, silver doesn't just revisit old highs, it challenges the structure that suppressed it for decades. This isn't about whether the bull market survives, it's about whether the paper pricing mechanism survives intact. The transition from paper dominance to physical dominance doesn't happen quietly, it happens under stress, and everything we're seeing, from margin escalation to vault drawdowns to ETF inflows, suggests that transition may already be underway. Let me know your thoughts below. Do you believe March becomes the inflection point, or does the system find another way to delay the inevitable? Either way, this is a moment to stay focused, stay unemotional, and watch the inventory, because as Andy said, price may be the weapon, but inventory is the confession.